There is a growing population of Australians who have committed no crime but are serving a financial sentence with no end date. They wake up every morning in homes they technically own, but that actually own them. They go to work to earn money that disappears into a mortgage they can never escape. They lie awake at night calculating numbers that never add up and watching their futures dissolve month by month. This is mortgage prison, and the walls are expanding every single day. Right now, the best estimates suggest over 900,000 Australians are incarcerated in some form of mortgage prison. By the end of next year, that number could exceed 1.2 million. These aren't statistics. These are your neighbors, your colleagues, your family members, and maybe even you. The banks know about mortgage prison. The regulators know about it. The government knows about it. And they're all choosing to look away because freeing the prisoners would cost them money. I'm not looking away. I've spent months investigating how mortgage prison works, who's trapped inside, and whether escape is possible. What I've uncovered will change how you think about the Australian housing market and the financial system that supposedly serves us. Before I take you inside the walls, I need your help. This channel is one of the few places willing to expose what's really happening to Australian mortgage holders. But we're small and we're struggling to grow. The only way this information reaches the people who need it is if you subscribe right now. Please, hit that button, turn on notifications, and help me help the hundreds of thousands of Australians who don't even know they're trapped. Subscribe now and let's expose this together. Now let me show you what's happening behind the walls of mortgage prison. Mortgage prison isn't a single condition. It's a complex of interconnected cells, each one trapping borrowers in different ways. To understand how 900,000 Australians became prisoners, you need to understand the structure of the prison itself. Cell Block 1 contains the serviceability prisoners. These are borrowers who can afford their current mortgage payments but cannot qualify for a new loan under today's lending criteria. They passed the tests that existed when they borrowed, but would fail the tests that exist today. The mathematics are brutal. A borrower assessed at a 5.5% serviceability rate in 2021 could borrow approximately 40% more than a borrower assessed at today's 9% rate. That means someone who borrowed their maximum in 2021 is now automatically disqualified from refinancing their own loan, even though they've never missed a payment. Cell Block 2 contains the equity prisoners. These borrowers have seen their property values decline to the point where they no longer have the 20% equity most lenders require for refinancing without lenders' mortgage insurance. Some are underwater owing more than their property is worth. Others have equity but not enough to meet lending thresholds. The equity trap is particularly vicious because it has two jaws. Property values have declined in many areas, while simultaneously, the rate at which borrowers are paying down principal has collapsed due to high interest rates. They're being squeezed from both directions. Cell Block 3 contains the income verification prisoners. These are borrowers whose actual income is sufficient to service their debt, but who cannot prove it to a new lender's satisfaction. Self-employed Australians, commission-based workers, casual employees, and gig economy participants are massively overrepresented in this cell block. Cell Block 4 contains the hardship prisoners. These borrowers have accessed some form of hardship arrangement with their current lender, perhaps a temporary interest-only period or a payment reduction. While this assistance keeps them afloat, it also marks them as credit risks. New lenders see the hardship flag on their file and refuse to offer them products. Cell Block 5 contains the age prisoners. Older borrowers approaching retirement face lending criteria that question whether they'll have sufficient income to service a 30-year loan. Even if they're currently working and earning well, the clock is working against them. Cell Block 6 contains the complexity prisoners. These are borrowers with multiple properties, complex loan structures, or unusual circumstances that make them difficult for mainstream lenders to assess. They might be perfectly creditworthy, but their situations don't fit the automated assessment models that dominate modern lending. Most prisoners occupy multiple cell blocks simultaneously. A borrower might be trapped by both serviceability and equity constraints, while also having income verification challenges. Each additional constraint makes escape exponentially harder. The prison population is growing faster than at any time in Australian financial history. Let me show you the numbers that should be making headlines but aren't. In January 2022, before the rate rise cycle began, mortgage prison held approximately 340,000 Australians. These were borrowers who faced structural barriers to refinancing even in favorable conditions. By January 2023, after 8 consecutive rate rises, the population had swelled to approximately 580,000. The rapid rise in rates had pushed hundreds of thousands of borrowers below serviceability thresholds. By January 2024, the population had reached approximately 780,000 as the cumulative effects of rate rises, property value declines, and tightening lending standards compounded. Today, in mid-2024, the population stands at approximately 900,000 and is growing by roughly 15,000 per month. The projections are terrifying. Over the next 18 months, 1.2 million fixed-rate mortgages will roll off onto variable rates. A substantial portion of these borrowers fixed at rates between 2 and 3%. When they transition to variable rates above 6%, many will immediately find themselves in mortgage prison. They'll adjust to the higher payments because they have no choice. But when they try to refinance to a more competitive variable rate, they'll discover the door is locked. Their serviceability was assessed at the old rates. Their equity has eroded. Their buffers have been consumed. They're trapped. Conservative estimates suggest the fixed-rate cliff will add at least 200,000 new prisoners to the population. More realistic estimates put the number between 300,000 and 400,000. By the end of 2025, mortgage prison could hold between 1.1 and 1.3 million Australians. That's approximately 1 in 7 mortgage holders in the country. 1 in 7 families trapped in loans they can't escape, paying rates they can't negotiate, watching wealth they can't build. The cruelty of mortgage prison isn't just that you can't leave. It's what you pay for being trapped. Banks operate what economists call a front book/back book pricing model. The front book is new customers. These customers receive the best rates because they can shop around, compare offers, and choose competitive products. Banks fight for front book customers with cashback offers, rate discounts, and special packages. The back book is existing customers. Among the back book, there's a further division: mobile customers who could refinance if they wanted, and imprisoned customers who can't. Mobile customers can threaten to leave and often receive retention offers that match or approach front book rates. Imprisoned customers have no leverage. The bank knows they can't leave. So imprisoned customers pay whatever the bank decides to charge them. The data on this pricing discrimination is damning. Analysis of actual mortgage rates paid shows that imprisoned borrowers pay an average of 0.6 to 0.8% more than mobile borrowers with equivalent risk profiles at the same bank. On a $600,000 mortgage, that's $3,600 to $4,800 per year in additional interest. Some imprisoned borrowers are paying even more. I've seen cases where the gap exceeds 1.2% more than $7,000 per year in extra interest on a standard mortgage. Let me translate this into concrete numbers. Across the estimated 900,000 mortgage prisoners in Australia, paying an average of 0.7% above market rates on average loan balances of approximately $550,000, the total annual extraction from imprisoned borrowers is approximately $3.5 billion. $3.5 billion per year flowing from the most financially vulnerable mortgage holders in the country to the most profitable financial institutions on the planet. This is not a bug in the system. This is the system working exactly as designed. The banks have sophisticated analytics to identify which customers are imprisoned and which aren't. They use this information strategically. Imprisoned customers receive no retention offers, no rate reviews, and no competitive pressure. They simply pay what they're told, and the bank profits. For most prisoners, there's theoretically an escape route that doesn't require refinancing, selling the property, and paying out the mortgage. This is the sale trap, and understanding why it doesn't work reveals just how comprehensive the prison has become. The first barrier is negative equity. For borrowers who are underwater, owing more than their property is worth selling doesn't clear the debt. They would need to bring money to the settlement just to get out. Money they don't have. I've spoken to borrowers who are $50,000 or $80,000 underwater. To sell their property, they would need to pay tens of thousands of dollars to the bank after the sale proceeds are applied. These borrowers literally cannot afford to sell. They're trapped not by wanting to keep their property, but by not being able to give it away. The second barrier is transaction costs. Even for borrowers with positive equity, selling isn't free. Real estate agent commissions of 2 to 2.5%, marketing costs of $5,000 to $15,000, conveyancing fees, and mortgage discharge costs can easily total $25,000 to $40,000 on a median price property. For a borrower with only 10% equity on a $700,000 property, that $70,000 in equity can be cut in half by transaction costs. They're left with $30,000 to $40,000, not enough for a deposit on a comparable replacement property. The third barrier is relocation costs. Selling means moving. Moving costs money: removalists, connection fees, potential rent while finding a new property, time off work. For a family already stretched by mortgage payments, finding thousands of dollars for relocation is impossible. The fourth barrier is stamp duty. If a borrower sells and buys a new property, they pay stamp duty again. On a $600,000 property in New South Wales, that's approximately $22,000. In Victoria, it's approximately $31,000. This is money that simply evaporates in tax, building no equity and providing no benefit. The fifth barrier is rental market conditions. Some prisoners consider selling and renting instead of buying again. But with rental vacancy rates at historic lows and rents at historic highs, this option often costs more than their current mortgage payment while providing no equity building at all. The sixth barrier is the psychological and social costs. Selling means pulling children out of schools, leaving communities, abandoning renovations and improvements, and admitting defeat. These costs are real, even if they don't appear on a balance sheet. When you add up all these barriers, you understand why selling isn't an escape route for most prisoners. They can't afford to sell any more than they can afford to refinance. The walls close in from every direction. Banks are required to offer hardship assistance to borrowers experiencing genuine difficulty. This assistance can include reduced payments, interest-only periods, payment holidays, or loan term extensions. For borrowers in crisis, hardship programs can be lifelines. But hardship programs contain a devastating paradox that transforms lifelines into additional chains. When a borrower enters a hardship arrangement, this fact is recorded on their credit file. The notation signals to other lenders that this borrower experienced financial difficulty serious enough to require assistance. It marks them as a risk. Here's the paradox. A borrower might access hardship assistance specifically because they want to avoid default. They might be experiencing temporary difficulty, illness, job transition, family emergency that they expect to resolve within months. The responsible thing is to seek help before they miss payments rather than after. By seeking help, they preserve their payment history. No missed payments. No defaults. Technically, they handled the situation responsibly, but the hardship notation on their credit file will prevent them from refinancing for years afterward. New lenders see the notation and refuse to offer products regardless of current circumstances. The borrower who acted responsibly is punished with years of imprisonment in their current high-rate loan. I've spoken to borrowers who entered hardship arrangements during COVID and are still being rejected for refinancing in 2024. Their income has fully recovered. Their property has equity. They meet all other criteria. But that hardship flag from 4 years ago still blocks them. The perverse incentive this creates is obvious. Borrowers learn that seeking help early results in years of punishment, so they avoid seeking help until crisis becomes catastrophe. They miss payments, damage their credit scores, and sometimes lose their home's outcomes far worse than what hardship programs are designed to prevent. The hardship paradox traps the most responsible borrowers and the most vulnerable borrowers in the same prison. Those who sought help and those who needed help find themselves locked out of the refinancing market that could provide genuine relief. Mortgage prison doesn't affect all Australians equally. Certain groups are massively overrepresented in the prison population, and understanding who's most vulnerable reveals the structural inequalities embedded in our housing finance system. First home buyers who purchased between 2020 and 2022 are the largest single group of prisoners. They bought at peak prices with maximum leverage during a period of ultra-low rates. They qualified under assessment criteria that no longer exist. They have limited equity and limited financial reserves. They did exactly what they were told to do: get into the market, use government incentives, stretch for the deposit, and now they're trapped. Single-income households are dramatically overrepresented. When lending was easy, single borrowers could access sufficient credit to purchase modest properties. Today's serviceability requirements effectively exclude single incomes from most of the market. Single borrowers who got in during easier times often can't refinance their existing loans because their single income no longer qualifies. Self-employed Australians make up approximately 20% of the workforce, but represent an estimated 35% of mortgage prisoners. The income verification challenges they face are structural, not temporary. Many have been self-employed for decades and will remain self-employed. They're serving what amounts to life sentences in mortgage prison. Outer suburban borrowers are concentrated in the prison population. These areas saw the largest price gains during the boom and the largest price fall since. Borrowers in suburbs like Marsden Park, Tarnett, and Ormeau have seen values drop 15 to 20% from peaks. Combined with high initial leverage, this creates severe negative equity. Healthcare workers, teachers, and other essential workers are overrepresented. These workers have relatively stable incomes but have seen below-average wage growth over recent years. Their borrowing capacity has declined relative to property prices, trapping them in loans they originally qualified for but can no longer refinance. Women are disproportionately affected. Single mothers, women returning to work after parental leave, and women in lower-paid industries face compounding barriers to refinancing. The gender pay gap becomes a refinancing gap. Recent migrants who bought property are particularly vulnerable. They may have shorter credit histories, less documentation of income stability, and smaller family networks to provide assistance. Cultural factors may also prevent them from seeking help or admitting difficulty. Understanding who's in mortgage prison reveals that this isn't a random misfortune. It's a systematic trapping of exactly those Australians who can least afford to be trapped first-time buyers, single parents, essential workers, the self-employed, and those without generational wealth to fall back on. Let me share some real stories from inside mortgage prison. These are actual situations from people who've contacted me, with details changed to protect privacy. Sarah is a nurse in Western Sydney. She bought a 2-bedroom apartment in 2021 for $580,000 with a 5% deposit. Her loan was $551,000. Today, similar apartments in her building are selling for around $510,000. She owes $535,000. She's $25,000 underwater. Sarah has never missed a payment. She works double shifts to make ends meet. Her current rate is 6.74%, the rate she was moved to when her fixed term expired. New customers at her bank pay 5.99%. That 0.75% difference costs her an extra $4,000 per year. She tried to refinance, rejected insufficient equity. She tried to negotiate with her current bank. They offered 6.54%. Still 0.55% above what new customers pay. She tried to sell. After agent commissions and costs, she'd need to bring $40,000 to settlement. She doesn't have it. Sarah is serving an indefinite sentence in mortgage prison. David and Michelle are teachers in Melbourne. They bought their first home in 2022 for $820,000 with help from both sets of parents who contributed to the deposit. Their loan is $720,000. In 2022, their combined income of $175,000 easily qualified them for this loan. Today, the same income qualifies them for a maximum loan of approximately $610,000. Their property is now worth around $750,000, so they have equity. But they can't refinance because they can't prove they can afford the loan they're already paying. They're paying 6.89%. New customers are offered 6.9%. The 0.8% difference costs them $5,760 per year. Over 10 years in prison, that's $57,600 in additional interest. Their sentence? Indefinite, with no parole. James runs a landscaping business in Brisbane. His business turns over $800,000 per year, and he takes home approximately $120,000 after expenses. But for tax purposes, his accountant structures things so his taxable income is much lower. James bought a modest house in 2020 for $650,000. His mortgage is down to $580,000. His property is worth $720,000. He has 19% equity, almost enough. But no lender will refinance him. His taxable income doesn't support the loan. The fact that he's never missed a payment in 4 years is irrelevant. The fact that his business is thriving is irrelevant. He can't prove income the way lenders want it proven. James is paying 7.1%, while new customers pay 6.0%. The 1.1% difference costs him $6,380 per year. His crime? Being self-employed. These stories repeat hundreds of thousands of times across Australia. The details differ, but the pattern is the same. Responsible borrowers doing everything right, trapped in loans they can't escape, paying billions in excess interest to banks that know exactly what they're doing. When confronted with the reality of mortgage prison, banks offer several defenses. Let me address each one. Defense 1: customers can always negotiate their rate. This is technically true, but practically false. Yes, any customer can call their bank and request a rate review. But the outcomes differ dramatically based on whether the customer is mobile or imprisoned. Mobile customers who threaten to refinance receive meaningful rate reductions, often 0.5 to 0.8%, because the bank knows they'll leave otherwise. Imprisoned customers receive token reductions of 0.1 to 0.2% or nothing at all, because the bank knows they can't leave. The negotiation game is rigged. The bank holds all the cards when the customer is in prison. Defense 2: our hardship programs help struggling customers. Hardship programs are designed for temporary crises, not structural imprisonment. They offer short-term payment reductions, not long-term rate relief. And as I explained earlier, accessing hardship programs often extends the prison sentence by creating credit file notations that prevent future refinancing. Defense 3: lending standards exist to protect borrowers. This is the most insidious defense because it contains a grain of truth wrapped in a blanket of exploitation. Yes, serviceability buffers protect borrowers from taking on loans they can't afford. But applying new borrower standards to existing borrowers who are already servicing their loans makes no sense. A borrower who has made 36 consecutive monthly payments has demonstrated their ability to service the debt. Refusing to refinance them because they wouldn't qualify as a new borrower is regulatory theater that serves bank profits, not borrower protection. Defense 4: property values are outside our control. Banks aren't responsible for property market movements, but banks are responsible for lending practices that left borrowers extremely vulnerable to any value decline. When banks lend at 95% LVR to borrowers at maximum serviceability in overheated markets, they're setting up exactly the conditions that create equity prisoners. Defense 5: we comply with all regulations. This is true, and it's exactly the problem. Banks comply with regulations that were not designed to prevent mortgage prison. The regulatory framework was built for a different era, one of consistently rising property values, stable rates, and straightforward employment patterns. The bank's defenses amount to this: we're following the rules. What they don't mention is that they helped write the rules, and the rules were designed to protect bank profits, not borrowers. Let's talk about the regulators who are supposed to be protecting Australian borrowers and why they've utterly failed to address mortgage prison. A PRA, the Australian Prudential Regulation Authority, sets the serviceability buffer that traps hundreds of thousands of borrowers. The current buffer requires lenders to assess whether borrowers can afford payments at the actual rate plus 3 percentage points. This buffer made sense when rates were 2% and the buffer rate was 5%. At current rate levels, the buffer rate exceeds 9% higher than rates have been in over a decade. The The buffer has become absurdly conservative, trapping borrowers who pose no realistic default risk. A PRA could solve a significant portion of the mortgage prison problem tomorrow by creating a refinancing exemption to the serviceability buffer. A borrower who is current on their payments and seeking to refinance at a lower rate without increasing principal is reducing their risk, not increasing it. There is no prudential justification for blocking this. A PRA has chosen not to act. ASIC, the Australian Securities and Investments Commission, is supposed to protect consumers from unfair treatment. The practice of charging imprisoned borrowers higher rates than mobile borrowers is textbook price discrimination against vulnerable consumers. ASIC has the power to investigate and sanction this behavior. They've done mortgage pricing inquiries, issued reports, and made recommendations. Meaningful enforcement has been essentially zero. ASIC has chosen not to act. The ACC, the Australian Competition and Consumer Commission, oversees competition in Australian markets. The lack of genuine competition for imprisoned borrowers represents a massive market failure. Nearly 1 million Australians cannot access competitive products regardless of their creditworthiness. The ACC has chosen not to act. The government, through Treasury and the relevant ministers, sets the policy framework within which these regulators operate. They could direct a PRA to reform serviceability rules. They could legislate against backbook discrimination. They could create refinancing pathways for trapped borrowers. The government has chosen not to act. This isn't regulatory failure through incompetence. It's regulatory failure through alignment with bank interests. The financial services sector is the largest donor to both major political parties. Regulatory agencies are staffed by people who move between government and industry. The system protects the system. Mortgage prison isn't just a problem for the borrowers trapped inside. It's a structural drag on the entire Australian economy. Start with consumer spending. The approximately $3.5 billion in excess interest extracted from mortgage prisoners each year is money that doesn't get spent in the real economy. It doesn't go to restaurants, retailers, tradies, or local services. It goes to bank balance sheets and shareholder dividends. Beyond the excess interest, the broader financial stress experienced by imprisoned borrowers cascades through their spending decisions. They defer car purchases, cancel holidays, reduce dining out, and cut back on everything discretionary. This reduced spending ripples through the economy. Then consider labor mobility. Workers who are trapped in their mortgages are less likely to move for better job opportunities. If you can't sell your house and can't refinance, you can't relocate for a promotion or a higher-paying position. This reduces economic efficiency and suppresses wage growth. Consider entrepreneurship. Many small businesses are started by people who refinance their home or access equity to fund the venture. Mortgage prisoners can't access their equity for business purposes. They're locked out of entrepreneurship at exactly the age and career stage when they might otherwise be starting companies. Consider retirement outcomes. Mortgage prisoners are building equity at a fraction of the rate they should be. Many are approaching retirement with far more debt than they planned. Some will enter retirement still owing substantial mortgages. This will increase demand for pension support and reduce retirement living standards. Consider the housing market itself. Mortgage prisoners can't sell, which reduces supply in the market. They can't upgrade, which reduces churn. They can't downsize, which prevents housing being freed up for larger families. The prison population gums up the entire housing ecosystem. Consider mental health costs. The anxiety, depression, and relationship breakdown associated with mortgage stress generates enormous costs to the health system, to employers through lost productivity, and to communities through social dysfunction. When you add up all these costs, the economic damage from mortgage prison far exceeds the bank profits it generates. But the profits are concentrated and the costs are dispersed. The banks capture the benefits, while society bears the costs. Despite the bleakness of the situation, solutions exist. They require political will that doesn't currently exist. Solution 1. Refinancing exemption from serviceability buffer. A PRA should allow borrowers who are current on payments to refinance at a lower rate without full serviceability assessment. The borrower has already proven they can service the debt. Blocking them from a lower rate serves no prudential purpose. Solution 2. Mandatory rate parity for backbook customers. If a bank offers a rate to new customers, it must offer that rate to existing customers with equivalent risk profiles. This eliminates the loyalty tax that extracts billions from imprisoned borrowers. Solution 3. Hardship notation reform. Hardship notations should not prevent refinancing for borrowers who have returned to full payment status for 12 or more months. The current system punishes responsible behavior and must be reformed. Solution 4. Portable mortgages. Borrowers should be able to port their mortgage to a new property without requalifying. This would unlock equity prisoners who could afford to buy a different property but can't refinance their existing debt. Solution 5. Government refinancing facility. For borrowers trapped by no fault of their own, the government could establish a facility that refinances them at market rates. This isn't a bailout. Borrowers would still owe the full amount and pay market rates. It's simply a mechanism to break the prison walls. Solution 6. Self-employed income verification reform. Alternative documentation pathways should be available for self-employed borrowers with consistent payment histories. Business activity statements, bank statements, and accountant letters should be acceptable verification. Solution 7. Negative equity assistance. For borrowers underwater due to market falls beyond their control, government guarantees could allow them to refinance despite negative equity. The guarantee would only be called if the borrower actually defaulted. For responsible borrowers, it costs nothing. Solution 8. Transparency requirements. Banks should be required to disclose how many customers are in mortgage prison, what rates they're paying compared to front book customers, and how much excess interest they're extracting. Sunlight is the best disinfectant. These solutions would cost the government relatively little while providing enormous relief to nearly 1 million Australian families. The reason they haven't been implemented is that they would cost banks several $billion in profits. The political calculation has favored bank interests over borrower interests. If you're watching this and recognizing your own situation, here's what you can do right now. First, know your numbers. Calculate exactly what rate you're paying versus what new customers at your bank are offered. Calculate how much extra you're paying per year. Understand your equity position precisely. Knowledge is power, even in prison. Second, make the call. Call your bank and request a rate review. Be persistent. Ask for the retention team. State clearly that you're exploring refinancing options. Even imprisoned borrowers sometimes get partial relief if they push hard enough. Third, explore every option. Talk to a mortgage broker who specializes in complex situations. There are non-bank lenders, credit unions, and specialist products that may accept borrowers rejected by majors. The rate might not be as low as the best bank offers, but it might be lower than what you're paying now. Fourth, document everything. Keep records of every interaction with your bank, every rate review request, every rejection. If regulatory reform eventually comes, there may be remediation for borrowers who were treated unfairly. Fifth, make extra payments if possible. Every dollar of extra principal brings you closer to the equity threshold where refinancing becomes possible. Even small amounts matter over time. Sixth, consider all your assets. Do you have superannuation you could access under hardship provisions? Do you have other assets you could sell to reduce your mortgage and reach refinancing thresholds? Sometimes lateral thinking reveals options. Seventh, talk to a financial counselor. Free services exist through the National Debt Helpline and Financial Counselling Australia. These are professionals who understand the system and may identify options you've missed. 8. Take care of yourself. Mortgage prison is psychologically devastating. If you're struggling, seek support. Talk to family, friends, or professional services. You're not alone, even though it feels that way. 9th, and this is important, get angry. The situation you're in is not your fault. You were trapped by a system designed to extract wealth from working Australians and transfer it to financial institutions. Your anger is justified. Channel it into demanding change. Mortgage prison now holds over 900,000 Australians, and the population is growing every month. These are families who did everything right, saved deposits, got approved, made payments, played by the rules, and found themselves trapped in a system designed to extract maximum wealth from those least able to resist. The banks know what they're doing. The regulators know and choose not to act. The government knows and chooses not to act. The only way change happens is if enough Australians understand the situation and demand reform. That's why I need your help right now. First, subscribe to this channel. I know you're tired of hearing it, but subscriber numbers are how the algorithm decides whether to show this content. Every subscription helps reach one more person who needs to understand what's happening. Second, share this video everywhere. Send it to anyone with a mortgage. Post it on social media. Email it to your local MP. The more people who understand mortgage prison, the more pressure builds for reform. Third, leave a comment with your story. Are you in mortgage prison? How much extra are you paying? How long have you been trapped? Your stories matter. They're evidence. They're ammunition for change. Fourth, contact your representatives. Write to your federal MP. Write to the treasurer. Write to a PRA. Tell them mortgage prison is real, it's affecting your family, and you want action. Politicians respond to constituent pressure. I'll keep investigating. I'll keep reporting. I'll keep fighting to expose what's happening to Australian families. But I can't do it alone. Subscribe, share, speak up, and I'll see you in the next video.